Okay, thank you. So I will start from my website. I want to show you where all the materials are related to my presentation, and then we will come back to the presentation. So first of all, if you plug in Google my last name is unique, and you see that the first search is related to conditional value at risk optimization. But what is funny is that further, there are the most popular strings for search. And so here is Oksana Uryasev, my wife, then Sivar Uryasev. So Google thinks that Sivar is my first name. And then Oleg Uryasev, my youngest son. Okay, that's kind of interesting. But maybe before going to my website containing materials, I want to show you the website of my wife, Oksana Uryasev, and she has PhD in statistics, but her website deserves to be watched because she is also an artist. So here, for instance, mosaic, which is in my house in Port Jefferson, which has been done by her, and that's her one of most recent paintings, and I think that kind of this woman says that I am beautiful, I am rich, and I have a smart husband. So that's my that's my interpretation of that. But anyway, if you search her name, you will see many quite unusual paintings, which follows that she has PhD in statistics. So that's the reason. Okay, but let's come back to the search and start with a search of my last name. Since my last name, that's the first link, it actually links it to my Stony Brook University website. And if you go to more popular page publications, then you will see here near recent publication about drawdown beta and portfolio optimization. And my talk is mostly related to this paper, which you can download from my website. Okay, and the other quite popular link is research, and in the research you see that the top link is drawdown beta for stocks, and you can consider my presentation as an explanation of this website. So what this website is about? The website shows for S&P 500 stocks standard beta, which is here. Say, for instance, if we would order it by standard beta, then let's order it again. So the highest standard beta has this stock, okay? And also here is a maximum drawdown, which has been observed over which time, over 10 years period, maximum drawdown was near 100%, that it has high standard beta, so it goes along the way. But most interesting part of this website are so-called expected regret of drawdown beta. So the paper which I have shown you on the website is about expected regret of drawdown beta and CDR beta. So what these betas are about? So standard beta, you know that it's a correlation, normalized correlation of security to the market. So basically it says that on a regular basis, say if standard beta is negative, let's search for low standard beta. Okay, there is no even one security in S&P 500 which has negative standard beta, so meaning a negative correlation with the market. standard beta is a pretty important characteristic showing relation of security with the market. If it's negative, supposedly it's a good hedge. But we learned from one of the presentation, Natalie has done a very interesting presentation showing how dynamically correlations are changed. And she showed that when there is a crisis, actually correlations dramatically change. So whatever has been hedged on a longer time period when everything was calm may not become hedged anymore. Okay, that's first. And second, let's hedge the risk related monthly basis. But investors do not invest for 1 month usually. They invest, I mean, at least majority of investors, such as pension funds, so they invest for much longer time period. So they don't worry so much about these monthly risks. They rather worry about risk of losing significant amount of money versus some investment which they made. If they lose 50% of investment in some security, that's would be viewed as a really bad. And what kind of risk measures this type of risk? This is quite standard in active investment community risk measure, which is called drawdown. So drawdown is loss of the security compared to the previous maximum. And now when say S&P is in drawdown, say S&P say losing 50%, true hedge is a hedge which will make over this amount of money what would be equal to the loss of S&P. Okay, so for instance, if you buy at the money put option on S&P 500, that would be your good hedge. But the problem with put option, it's quite expensive. So it has a negative rate of return according to standard CAPM and so on. But here, the idea of this website and the paper, which I will explain a bit later on, try to find securities which have this natural possibility to hedge when market is in drawdown. Over the times when market keeps going down, but this security keeps going up and up and up. So it's a hedge over longer time periods, not 1 month, but whatever drawdown time, drawdown sequence of S&P, you just look at the same time period for the security and just see how it behaves. Okay. So these ERAT beta expected regret of drawdown is along the lines. It's not exactly what I said, but it's similar characteristic. So what, for instance, if I will do a search here and I will order the stocks according to ERAT beta, then for the 10 period time from the current time, it's third month of this year, 10 years back, you would see that these are securities which had negative betas, negative ERAT betas. It means that these securities performed well over this time period and really protected from drawdowns. It from S&P 500 drawdowns. It doesn't necessarily mean that this security will perform similar way when there will be next big drawdown. It just showed that historically this security performed very well in the previous drawdown. But it's already very important information, because if you would ask the question, which securities performed well during the previous drawdown? And immediate answer, search my last name, go to this website, and just order it according to IRAD beta, and you will see which securities performed well over the previous drawdown. And at least it's a very important tool for an analyst to have some ideas where to invest. And if, further on, the fact that its security performed well in the past doesn't necessarily mean that it will perform well in the future, but you should further analyze, indeed, the analyst should really pay attention why security performed well, or some it's a unique capability of this factor or unique time period like COVID-19 drawdown, and some securities performed really well because of this and that and that. So the further fundamental analysis will help you to decide if this performance will be consistent, persistent later on. But at least it's a huge resource, as for me. But as always, researchers are very excited about their research. They are supposed to. If they are not true researchers. Okay. All right. Let's move on. And
change the time period.
Yeah.
How stable are it?
Yeah, it's a good question, because basically it shows how to perform well in the previous drawdowns. If you pick up, say, 15 years period, it will pick up two largest drawdowns. It will pick up 2019 and 2008. If you take 10 years, then it will not pick up 2008 drawdown.
The drawdowns are different. The interesting question is, are the teacher names approximately the same? Then
Yeah. So that's exactly what you will be able to search here, because, say, for instance, let's pick 15 years, okay? Let's order, and you see MKTH, DAO are the best performers over 15 years, which takes into account mostly it concentrates on the drawdown 2008, okay? But now let's pick 10 years when already 2008 is not present there. And so if you search the ticker, it will probably somewhere further down. It means that where is it? Yes. Okay. No, it still shows up. It means that it also performed quite well when you edit one more drawdown. Okay, one more big drawdown. So it's still negative. But pay attention that standard beta does not show at all these characteristics. To be simple, standard beta does not show riskiness of the stock related to the periods which are most important for investors, because these big losses are the most troublesome for investors. And standard beta, although extremely popular, is not showing this because it cannot show it by design, because it's not showing consecutive losses over, say, 5-6 months. When the beta is calculated, you just chop all data, take on monthly periods, and just calculate correlation, and that's it. Okay, so it cannot show consecutive losses by design. Okay, so it's not designed. I'm not criticizing standard beta. I love it. But for some reason, it works very well. Okay, but let's move on to the presentation to really discuss in more detail what is it about, and the story actually started quite a while ago, if you search on my website publication and search for drawdown term, you will find that the first publication was like in 2005, and that's I will start from this publication, just introduce you the main notions and explain you ideas which were involved in this initial research. Control L. Okay. So you can download from my website the paper with Chekhlov, and he's actually driving, or at least at that time, driving research in this direction. Chekhlov is my colleague. At that time, he worked for a hedge fund, and he was a quite successful, employee at this hedge fund. And hedge fund, it was a prominent hedge fund which has been on the market for nearly 20 years and having a return, yearly return over 15% per year, and so on. So he worked for several years, and then he left the company and he has started his own fund. And then between these changes of jobs, I was in contact with him, and he shared with me what kind of technologies they have used in this hedge fund. So basically, what they have done, they had about 15 different trading strategies and futures, and the question was how allocate funding between the strategies, because the strategies had very similar principles, and they had a tendency to make money and lose money about the same time. Like you have futures in silver or gold, and what they have done, they had at that time 15 years historical period for performance of their strategies, and they mixed them and just watched how this mixture behaves, and then they just randomly picked up some weights and see how portfolio behaves, and mostly they measured the total return over 15 years with constant proportions, just constant amount of say money, say 5% to this strategy, and they performed this well over 15 years, and they observed the drawdown of the portfolio. I will explain shortly what the drawdown is, and after that they with random sampling found some other portfolios, and ultimately they found some portfolio which gave reasonable return and had some reasonable drawdown. But since I had I believe to be excellent background in operation research, I said whatever they are doing sampling for 1 week, I can do it in 1 second if I will use optimization methods, and that's how this research started. Okay, so the first paper you could find here describing this part of research. Although drawdown is a very important characteristic, not so much of research, academic research, is devoted to that, mostly because it's quite complicated, because it involves dynamics and so on. So this research has been resulted in a risk characteristic which is called conditional drawdown at risk. So basically we take 1 period drawdowns and then calculate average of worst case, say 10% drawdowns, and this is called conditional drawdown at risk. And I will show here the case study for portfolio of futures. So what the drawdown is, if this is a portfolio, then you just look at this time, say at previous peak, and a drop in portfolio value compared to the previous peak is called a drawdown. And why it measures the loss over time, because it conservatively says that if you are unlucky and invested at this time, then you are, say, losing 10%. So you cannot lose under any circumstances more than 10% if you look over all this previous time, because even unlucky people who invested here, say, losing only 10%, okay? Therefore, all actively managed funds, they report so-called maximum drawdown over some previous time, like 10 years or 15 years. And highly unlikely for actively managed account to be in drawdown more than 2 years, because investors would say, hey, something is wrong with this fund, and they will pull out of the fund. And also, if drawdown exceeds 20%, it's also a warning signal that usually investors take out the money. And when, say, portfolio has 15% drawdown, it means that compared to the previous peak loss is 15%, then usually warning signal is coming that, hey, continue working in this way and we will pull out our capital from you. And typical longest time to get out drawdown is 1 year for actively managed accounts. So as you understand that if you're speaking about loss over some time, you can measure it in different ways. The most standard way is when you consider that there is a multiplicative change in the value of your portfolio. And actually, in this case, it was a portfolio of futures, and where it was like a constant supporting capital. So there, it was not in multiplicative way, it was rather in summing way. So there are several reasons why for this type of portfolios it's important to work with so-called uncompounded portfolio value rather than compounded. Uncompounded portfolio value, when you start with some initial capital, the next time period you have this amount of money where R1 is a rate of return. But then it evolves according to summing up. So you consider that you are taking out whatever you're going got or lost, and then again start with the same capital. So you just add up a rate of return. So it's sum ups. And for me, it's reason because of several reasons. First of all, when there is a summing up, these trajectories actually are not skewed with this geometric exponential growth. So you would see on the trajectory similar performance in the beginning of the end, because return here are impacting the same way as because it's just add up. So impact of this return and this return is the same. But for me, even more important that there is a linearity here in the returns. So there is a possibility to involve easy ways to build a convex programming and really which results in a very, very efficient strategy. So I will show later on. So what is uncompounded cumulative portfolio rate of return? This sum is uncompounded return. So it's just sum of rates of returns, okay? Which is very simple. So working with uncompounded cumulative return, the maximum drawdown is if you consider, say, drawdown at time moment t. So you take in the previous time what was the peak of cumulative return minus current return. So it will be drawdown at time moment t. So if you would look at these uncompounded return, so at this time, it's a difference between total return here and total return here. If you then take a difference between this and that, you just see that it's just sum of recent 3 returns. So the drawdown is sum of recent 3 returns here, but with negative sign, because drawdown is positive. Returns are negative here, but sum is also negative. But with minus sign, it will be drawdown at time moment t. Okay. Now One more concern with the maximum drawdown, which is very popular in the industry, that maximum drawdown picks up some specific maximum drawdowns which have been observed in the past. And say, if we are looking, say, history 15 years, that it will be concentrating on drawdown happening in 2008. And if you're speaking about maximum drawdown, and then even drawdown in 2019 will not be penetrating to this calculation, because this drawdown is higher than the other one. Okay, because we have. But the idea is let's consider not the maximum, but say worst case 15% of drawdowns over time. And if you say have a trajectory, and here is so-called underwater curve, which is a drawdown. So when security goes down, drawdown is popping up, and then drawdown is going down, and that at that time when maximum is achieved, drawdown is 0, then it's drawdown about 0, and then again after that you again start concentrating on this peak. Okay, now if I will cut some level which I'm interested in, say for instance at 12%, then in this case I will be looking at these drawdowns and these drawdowns. So conditional drawdown at risk is average of worst case, say 10% drawdowns observed in the past. So it's a mixture of different drawdowns. And what you can do, you can actually consider, for instance, all drawdowns and average over all drawdowns. So on my website, this EROD beta conditional regret of drawdown, it's actually over all possible drawdowns except 0 drawdowns. Okay, and the other measure CDAR beta is for the worst case 10% drawdown. Okay, so there are 2 columns at the website, all and highest 10%. Now pay attention that that's only one sample pass. When you're working with historical drawdowns, we are working with some specific sample pass. And if you are sampling sample pass, then you can measure drawdown, and that will be characteristic of some specific sample pass. So what you can do, for instance, maximum drawdown, which will be that average drawdown, which calculate all drawdowns, or conditional drawdown at risk, which will be capturing in some fraction of that, but it's just for one pass. But actually, if you have a say simulating engine like a historical simulation, then you can simulate many sample paths, and then you could have a drawdown as a function of the sample path. And then for individual sample paths is say maximum or average or conditional drawdown at risk. But what you can do further on, you could say calculate maximum drawdown over possible time and over possible trajectories. So it will be take into account all possible sample paths. And here, for instance, CDAR, it will be calculating worst case 10% over trajectories, I mean over sample paths and over times. Okay, so for instance, if you have here the time and scenario or sample path, then that's how this drawdown surface looks like, and you cut it and you just calculate average of these peaks over some time. So that's CDAR based on multiple sample paths. Now, if you look at this risk measure, that it's positive, constant neglect, if you at the constant drawdown, if you move up on trajectories, then drawdown will change homogeneity, convexity. So it's a good risk measure from the point of view of properties. So it's possible to build a very efficient numerical algorithm for minimizing this risk measure. Okay. And maximum drawdown would be calculated if you take a conditional drawdown at risk and move alpha to 1, means that to worst case you will get as a limit maximum drawdown. Or if you take conditional drawdown at risk and take alpha to 0, it would take into account all drawdowns. Okay, and so conditional at risk, I want to remind some people already heard about that if you have some outcomes, then you order the outcomes and take, say, for instance, 10% of worst case. So conditional drawdown at risk is the average of, say, 10% worst case drawdowns over universe, over time, over sample pass. And for conditional drawdown at risk, it's known that it can be reduced to linear programming. So this constraint can be reduced to a system of linear constraints conditioning the function f is linear. And in this case, you see that my loss function is linear with respect to variable because or convex. Okay. So if it's convex with respect to x, then things are reduced to convex programming or linear programming. And the problem actually, which has been solved through brute force as a hedge fund, which we have started with, is when they consider that the total trajectory, how much money you make over the trajectory, and if you sample many trajectories that the expected value or total money which you make, say, over 15 years, if you sample many times 15 years, and subject to constraint on risk, subject to constraint on drawdown. And you could work with maximum drawdown, or with average drawdown, or with conditional drawdown at risk. And here is a case study which actually based on real life data. So number of proprietary investment strategies was 32. At that time, they have started, it was in 15 years, they have started from 20 million initial capital. Number of days, about 3,000, it's 12 years horizon. And so that's how uncompounded cumulative return is calculated. And they had a strategy where they had investment constraints that at least X minimum should be invested in this strategy, but maximum this amount of should be invested in this strategy. So at least 20% of capital is invested in every strategy, but maximum 80% of capital. But sum of weights does not sum up to 1. Actually, the portfolio is very leveraged because if you take a 32 multiplied by 0.2, that divided by 5, so like a minimum leverage is 5 in this portfolio. Okay, so it's a highly leveraged portfolio, and that's a real life how this performance looks like for some weights. And also, as I mentioned to you, that it's possible to do bootstrap simulations. Later on, actually, Chekhlov, when he worked on his hedge fund, he actually did the bootstrapping and working over very long simulated sample pass. Although theoretically it should be many sample pass and then it should be this way, but he took every sample pass, stick them together, and just running for 100 years how a hedge fund would behave, and then working with the maximum drawdown characteristic. Now, as I discussed, it's possible to reduce to convex programming, and here is how problem can be reduced to convex programming using CVAR. Here and additionally drawdown is plugged here. Whatever. If you're interested in, you can read. It's published, so it's possible to view that. And now have a look how this portfolio looks like, because it's an actual performance of the portfolio, which is a kind of amazing. As for me, having a quite good experience is actually hedge fund investing. That if you put say constraint 7% on maximum drawdown, then portfolio returns 50% per year, and it's based on actual historical performance. But in this case, you would consider, okay, this is how my strategies behave. Let's make the most advantageous allocation of money across these strategies. And if you knew how they would perform in future, in 15 years, or in 12 years, then how much money you would get. But you would see that how well strategies have been designed. Okay. So, and you see here, it's like a bang investment. Say, for instance, this strategy has 80% capital, 20%. Some of them are, I mean, not big bang, something like that. Okay. So that's a British pound futures. Okay. 80.2. What?
Sorry, what does the 0.8 mean?
0.8 means that 80% of capital is invested in this strategy.
All right. Okay.
20% of capital is invested in this strategy.
Okay.
So we already 100% invested, but they keep investing and investing and investing and investing and investing and investing. Okay. So it's these would be leveraged. I mean, like 5, and this would be such type of leverage that it's like a racing in the car, slightly left or right, and you will crash. Okay, so it's, but you see that return on investment, like I mean, almost 100% with a 70%, 17% maximum drawdown. How could it be? But people are smart.
Isn't this saying that you should not consider the drawdown constraint? The higher the drawdown value, the higher is the rate of return.
Yeah. So I mean,
So
the more
consider-
risk. So if you're allowing higher drawdown, which is a risk,
Yes.
it's portfolio gives you higher return.
So you should not consider the drawdown constraint, you are saying.
No, you should. I mean, because you want to be protected. You don't want to have high drawdown. So they probably working maybe with this portfolio, which has I mean drawdown 6% in sample, hoping a drawdown out of sample maybe 10%. Okay, because as I said, if drawdown exceeds 15%, investors are starting really worrying. 20% that they take money from you. And that's it.
But your results say that they should not worry. You just
No, but
Right.
it's in sample results. It's in sample results. It's not out of sample. It's in sample results. These are in sample results.
Could you say something about the strategies, like FX is part of it? These are long shorts, I assume,
I have no
strategies,
idea how the strategies are
or like
working.
FX, is, you know.
Yeah, I have no idea. I don't know how this proprietary.
And how often do you rebalance the portfolio?
They rebalance this portfolio every week.
And do you know anything about the transaction cost? Is this without? transaction cost?
Futures nearly zero transaction costs.
Well, it depends again what you're buying and
Yeah.
selling, yeah,
Yeah.
so.
And also it doesn't mean that they completely rebalance and sell and buy. It may be slightly shifting because the weights to the strategies are slightly adjusting over time, because you take a 12 years previous time and say, hey, over these 12 years, that was the most, I mean, beneficial allocation of funds among strategies. And these allocation will not change if you would add one more week to the previous history, and then they keep accumulating the history and using it as a guidance for allocation of money to the strategies. That's basically what they did. Okay.
Yeah, just looking at the column on the far right, you said we're so leveraged here that if you veer far right. Yeah. Sure. For example, so you said we're so leveraged that at this point, if we veer slightly to the left or slightly to the right, it's a total car crash. So
No, I mean that leverage is extremely high. Say, for instance, here 0.8 multiplied by 32, leverage is 30. 30. So your acceleration is 30. Okay.
Mhm.
You gain $1, I mean, in strategies, and then boom, you got 32% return, and you lose, and you gain 1%, and portfolio, I mean, strategy gains 1%, and then portfolio gains 32%, and
So-
it's per year, but it loses 1%, and portfolio loses 32%.
So if we, so risk of 17% really means 17 times 32%?
Risk 17%. It means in sample on these carefully selected weights, drawdown was only 17%. Drawdown was only 17%. Where is that? Come on. Drawdown on simulated portfolio was only 17%, but portfolio running for 12 years made 83% per year for 12 years. Okay. So that's basically what it says. No more than that. Okay, let's finish with introduction. So far, I'm speaking only about introduction, and the presentation is just coming. Okay. Yeah, but anyway, here are efficient frontiers, because there is a portfolio optimization, risk versus reward. This is say analog of Sharpe ratio. So with this investment, you would get maximum analog of Sharpe ratio, return per risk, and they have invested in this portfolio. But anyway, let's move on. The next, so I have discussed with you some historical material. Let's move on to more recent material. So mostly, this is more recent paper, and this earlier paper where there are formulas for betas. Okay, that's a formula here for TDAR beta, and here there is a formula for IRAD beta. So these are historical sample paths for S&P 500, and you see that the highest drawdown, so nearly 90% is in 30s, 1930s. Standard beta normalized correlation. Beta is a cornerstone of the capital asset pricing theory. And we will come to these things a bit later. Beta can be interpreted as a necessary conditions of extremum in Markowitz mean variance portfolio optimization problem. So actually, as soon as you formulate optimization problem, if you look at the necessary of conditions of extremum, there are lambda multipliers, and lambda multiplier has interpretation of beta. So as soon as you have a portfolio optimization problem, you take lambda Lagrange multiplier, and that's beta. And we had convex optimization problems for drawdown minimization. So we automatically have formulas for Lagrange multipliers, which are betas. Okay, and we just look at them and interpret them. Okay. Here are again some notations. So now a more mathematical definition, what is the expected regret of drawdown? If you take some threshold, for instance, 10%, and then you consider all drawdowns exceeding this threshold, so it's plus, it means big or equal, and then expected value, that will be expected return of drawdown, okay? And so that's in scenarios format. Now, if you say, look at portfolio optimization problems, you could say minimize expected regret of drawdown subject to constraint on cumulative return over the previous period. Or you can minimize conditional drawdown at risk, which I have explained with slides, subject to constraint on cumulative return. These are nice convex optimization problems. And we can consider necessary conditions of extremum and consider so-called CDR beta and ERAT beta, which are shown at my website. CDR beta is worst case 10% drawdowns, and ERAT beta is actually all drawdowns except 0 drawdowns. Okay. Drawdown betas may have very different values compared with a standard beta, but do not confuse with so-called downside beta when correlation is calculated over times when returns of S&P is negative. Actually, I'm also showing this so-called downside beta on my website, and it shows that downside beta is having about the same values as the standard beta. It does not provide you new information. Okay, although people were very much excited about that, but it doesn't contain any new information. So what is the interpretation? What is the formula for these betas? Because when I have started and said how to really identify if security behaved well or not well when market was in drawdown, just have a look. It behaved well or not well, all right? And it turned out that when you calculate the drawdown betas, that's exactly doing what you were supposed to do. And what is doing as follows, that CDR beta is doing as follows. When you take chains of returns of market when market is in drawdown and sum these losses over these times when market is in drawdown, market losses in the denominator, and in numerator, you put gains of losses over the same time over security. So basically, it's average gain or loss of the security over the same times as S&P was in drawdown. Okay, so that's it's coming as a necessary condition of extremum, and that's a very good engineering meaning. And ERAT beta is a similar when you just have a cutoff value for drawdowns, and then they consider all drawdowns exceeding some threshold and calculate the average value of market loss over these chains of returns, and then put in numerator the same chains of returns, how much security made over the time. It will be ratio, how much security made over drawdown time versus drawdown loss of market. As simple as that. And these are more mathematical notations. That's the conditional drawdown risk is in denominator, and here is some risk identifier which picks up some specific sequences which are 10% worst case, 10% worst case sequences corresponding to market losses. Okay, and similar for ERAT beta. Now let's explain to you, for instance, how it works when we work with alpha equals 1 for CDR beta. In this case, we will be concerned with maximum drawdown. So how you approach that? You would look and find the period where S&P is in maximum drawdown from this to that time. And then you would look how security perform over the same time. It say it made this amount of money. Then you put this amount of money in the numerator, and this actually security made 76% over this time. And S&P compounded, uncompounded return is actually over this time from 2008 beginning to the lowest point in 2009, uncompounded cumulative return is 70%, okay? Because it's higher than compounded, because it keeps losing, but you keep investing the same capital, okay? So, and the ratio is -1, and it's actually very intuitive because you say, if this security protected or have not protected you from loss, yes, beta equals -1 for the maximum drawdown beta. And it exactly says that the security over the maximum drawdown time lost exactly the same amount of, gained exactly the same amount of money as S&P lost. And that's what you can find in my database if you go to the website, okay? Because you can search with 15% of 15 time period to 10-year period, which security behaved well, okay? And it's really magnificent. I don't know why my website is not super popular. It should be super popular. Yeah, because I have a practical experience. I mean, I know what should be popular. Because it's a very rare combination when people have both a strong theoretical background and practical background, and there are very few people actually who has it, and I am one of them, okay? So now you see, for instance, betas for those 30 stocks for 15-year period, and you see that, for instance, standard beta for Apple equals 1, downside beta, where you have correlation over times when S&P going down, again 1, doesn't show you anything. But Apple has negative 0.6 beta, okay? All right, ERAD beta, when you take into account all drawdowns, when you take into account only maximum worst case drawdown, it's still negative slightly, but at least it's around 0. It means that all this time Apple didn't lose money. All right, this is how Apple behaved, and it numerically says how it behaves, okay? And you see that there are some negative values even in Dow Jones stocks, all right? But say, for instance, that negative, pretty strong negative, although standard beta is 1.3, okay?
Do you see any patterns like that you could say that cyclical industries tend to have a negative?
This needs to be studied. This needs to be
Yes.
studied to really.
Because that would be interesting to actually explore and have an economic understanding of what drives those negative.
Yes. This needs to be studied really to understand, because of the new characteristic showing this performance, but explanation why this is the case, if it's repeatable, not repeatable. Because why you would be interested in cyclicals? Because they next cycle they will behave in a similar way. Okay, so that's exactly the question which should be asked, which has not been actually studied. Okay, because we just studied this from a purely operations research point of view, like optimization, necessary conditions of extremum, blah blah blah, but no true economic studies. But the question was like. Have these negative beta have any kind of predictive capability? If it's negative, will be again negative. And what we have done, we took 14 years of data and split it in 2 7-year periods. One 7-year period had crash 2008, big drawdown. The other 7-year period has crash 2019. And we have calculated betas over the 1 7-year period based on one crash and beta based on the other crash. And then we try to look at whether they keep, if the one is negative, so it means performed well during the previous 2008 crash, if it performed well during the 2019 crash. And these crashes are very different in fundamental factors. One is because of financial crisis, the other one because of health concerns. And surprise, surprise, when we say took those 30 stocks and we have started calculating correlations of these betas calculated over different periods, we have found that, for instance, standard beta has a correlation 0.6, 0.7, quite well correlated. Means that if on monthly basis it was performed well or bad, in the first 7 years, it's similar in the next 7 years. But regarding the CDR beta, it has also very high correlation, nearly 0.5. It means that there is a very strong persistence. So if security performed well during the crash 2008, was a defensive security. It keeps being most probably the chances like 50% also defensive security over the next crash, which is absolutely unrelated, okay? But interestingly, if you would start considering S&P 100 stocks, then standard beta has about the same value, but here persistency decreasing. But if you take all S&P 500 stocks, persistency keep decreasing. It means that bigger companies have a more persistent drawdown characteristics versus small companies, okay? Which is already quite important. If you build a defensive portfolio, then big companies may behave similar versus smaller companies, okay? And now a quick explanation to you why these why it could behave. Why, say, for instance, CDR beta is minus 2.3 for Netflix, but standard beta 0.85, and that's 2008. Because you see that how S&P behaves and how Netflix behave, and you see that there is a similar pattern. So on monthly basis, correlation is normalized correlation 0.85. But if you look, for instance, at this period from here to here, the S&P is still being in drawdown. It picks up 15% or 10% was case drawdown. But Netflix already made a ton of money over the same time. Okay, that's why Netflix beta is so negative over this period, just showing over the same times how Netflix behaved. And then finally, here, but Netflix already made 2 times more money than S&P is losing. Okay, all right, but you should decide if Netflix will keep doing this way, not doing. That's your call.
Well, this is during the crash.
Right, it's 2000.
Losing their jobs and home, what you tell it.
Yeah, during the crisis, Netflix, birth rate increased, jumped twice. In the United States over the time. What people do? They
See what happens.
Netflix and enjoy life. Okay, so as simple as that. Now, I have used up all my time. Am I right? Let's give me just one quick moment I will show you also my other website, which is having which has case studies containing data, including the data set which I have described. There is a case study for, say, running for 100 years a trajectory, and that's a case study which is called optimization with drawdown constraint, single pass versus multiple pass. And if you look at this problem, that it has a number of days, 200,000, okay, and number of variables 18. Actually, if you reduce to linear programming, it will be 10 power 10 number of linear variables. So although it's formally it's reduced to linear programming, it's not recommended to reduce, but I'm using the software which is called Portfolio Safeguard, and it actually solves this problem during 5 seconds. And it's free for academic studies. You can request an academic license and indeed solve these drawdown optimization problems, and including downloading data using different software, whatever. So that's basically what I try to share with you. I'm really excited about this research. Probably you feel my radiation of excitement, and I hope you are infected with this excitement and radiation. Okay, thank you.